There's a common preconception that investing is only for the rich or for those who work in finance, and this is simply just not true. You might be surprised to find how many people around you that you know do actually invest their money into the stock market. And you can start from as little as £1 and build it up as you start to grow and your confidence increases. Hi, I'm Katie and welcome to my channel. I make videos on things that I find helpful and hope that they might help somebody else. So let's get started. This is a video that I've wanted to make for a while and I'm keen to educate you. So the first question to answer is, why do people invest in the stock market? And a lot of people think that people invest into the stock market to get rich quick and to make lots of money. But this isn't entirely true. Some people definitely do that, but a lot of the time people invest their money purely to overcome the inflation rate. So what is inflation? Inflation is where the costs of goods and services actually increases every year, and this on average is a rate of 1.5% to 2% every year. So this means that the cost of things is going up and your money is staying the same. So in layman's terms, things are getting more expensive, and unless you're earning more money, you're not going to be able to keep up with the increase in price of things. Now, a prime example of inflation is the Freddo. So I remember the Freddo always being 10p when I was little, so I decided to look into the history of the Freddo. And actually in 1994 the Freddo was 5p, and then the time it got to 2005 when I was 10 years old, the Freddo was 10p. And then by the time it got to 2017, the price of the Freddo had increased to 30p. And in 2017, a lot of customers sort of complained about the price increase to Cadbury's. People were astonished at how the price had gone up so much, because this is actually an increase of 600%. So the Freddo's price had increased by 600%. And obviously this is a small amount when you're talking about small amounts of change, but still 600%, come on. So actually what Cadbury's did was they decreased the price to 25p, so they sort of said, okay, maybe we're doing too much here, we'll take the price back. So the Freddo is now currently 25p. But when you look back at, I remember it being 10p and it's now 25p, that's still a fair amount. That's a 150% increase in just my lifetime of 20 years. And that is a prime example of how things increase in cost over time. Another example I want to bring up to you is the cost of house prices. Obviously house prices are slightly different, they have their own sort of market, they're done slightly differently, but they are known as a good investment to make because house prices increases with inflation. So my parents bought their house in 1998 for £99,000, and they had the house priced a couple of years ago and it got valued at £250,000. So again, that's a 150% increase. Now if you think about that in terms of how much your money's worth, say somebody had £100,000 in the year 2000, they could quite happily buy a 2-bedroom house with that. He kept that into a bank account, and then 20 years later, in the year 2020, he went to buy a house and he wouldn't be able to buy the same house. He would only be able to afford, say, a very small flat. Where I live, you couldn't even afford a flat for £100,000. So that just goes to show that the price of things is increasing, and even if you have the same amount of money, you definitely can't afford the same amount of things with that money. So there are two ways to look at inflation. You can either look at the cost of things increasing, or you can look at it as the price of your money is decreasing, or the value of your money is decreasing. Okay, so what is the stock market? When you buy a stock of a company, you are essentially buying a fraction of that company and owning it. So you're giving them money to own a small part of that company. And what you hope to see is that that company grows in size, makes more money over time, finds new avenues to sell, new products to sell, expands the business, and therefore the company is worth more in the long run. And this would mean that your share is also worth more. And it's also important to add that companies will be aligned with inflation because they are the ones selling the goods and services, so they are the one increasing the price of the goods and services that are being sold, and therefore making the cost of things more expensive. Now, you probably have heard stories or adverts on Facebook and things of saying, I made £1 million through the stock market and all of that sort of stuff. But it is very important to bear in mind that this only happens if you happen to invest into like a startup business and this later on becomes a multi-million or billion-pound business. So for example, Apple, Google, Tesla, Facebook, all of those big companies, they did start somewhere and they did start very small, and a handful of people would have invested into that company when it was at the very beginning stages, and that share has ballooned obviously and become now like a million, maybe even £1 billion worth of a stock. So if you've seen a chart of the stock market, you'll know that it has peaks and troughs, and it doesn't go just on a directly upward direction. It does have peaks and troughs going up and down, but gradually in an upwards direction. And this is why it's seen as a long-term investment. Most people that invest into the stock market are doing it long-term, and they're not putting it in and then hoping to withdraw it very soon after. They sort of put it in, wait for it to grow, and then later on, when they're a little bit older and they need the money, or they're looking to retire, or whatever the reason is, then they pull it out and it's at a positive growth. Now the key thing, the most important thing to know when investing into the stock market is you are only losing money if you sell at a loss. If you don't sell it, you're not losing any money. So if you see the value of your stock going down and it's at a minus percentage, don't panic. Yes, it's worth less than when you bought it, but it's very likely that it will make that money up again and then become a positive. Another area of investing that you might have heard of are day traders, and basically what these people do is they constantly trade back and forth every day, constantly at their computer, and they buy a stock in the morning and they hope to see it grow towards the day, and they are making a small growth. But this is very small growth. This is sort of, maybe they're making 1% in a day, or 0.5% or 0.2%, but when it's so much money and when they're doing so many of them, they tend to make a profit. But this is a very skilled job. You have to have a lot of training and a lot of knowledge to be able to do this. Don't be fooled by those adverts on Facebook that say you can do it, you can make lots of money and become like a forex trader. Unlikely. Most people that do this lose all their money. Okay, so that's the sort of brief introduction into what the stock market is and a little bit about how it works. And the first thing I want to talk about now is how you buy and sell them. So you have to go through a stockbroker, and they are basically the companies that hold the stocks. They're like the stock library, and they do the transactions for you. So if you want to buy or sell a stock, you go to them to get it done for you. A lot of people, I don't think, are aware that when you buy or sell a stock, you actually have to find somebody to either buy it from or somebody to sell the stock to. So it's not like a shop where you just pick it off the shelf and say, yep, I'd like that, and then when you're done with it, you just put it back on the shelf and say, yep, done with that one, don't want it anymore, money back please. You actually have to find somebody else to have that, so each stock has to be sort of assigned to somebody at any time. It's not like they just have a library of these stocks and they just give them out willy-nilly. There is a set limited amount of stocks in a company, and therefore they are sort of traded, so this is why they're called traders. They're trading these between people. And it's for this reason that you can ask for a different amount to the estimation. So when it comes to, for example, selling a stock, you could ask for slightly more than the estimated price or the given price by the stockbroker or the company. And similarly, if you're trying to sell it, you could ask for a little bit more. I feel like I'm saying the same thing twice. If you're trying to sell it, you can ask for more. If you're trying to buy, you can ask for less. So you can put in parameters when you're using the stockbroker and say minimum or maximum cost for the transaction. So you can actually limit how much. And then it's that stockbroker's job to find someone who will match your criteria. Do their minimum and maximum parameters match yours? Can the transaction go ahead and make both parties happy? Okay, so the next thing I'm going to talk about is the effects of recession onto the stock market. So the definition of a recession is economic decline for 2 quarters or more. And what this means is basically the spending of a country in total is in decline for 6 months or more. So a quarter is a quarter of a year. So if they talk about Q1, that means January, February, March, the first 3 months of the year. And for example, Q4 would be the last 3 months of the year. So they talk about Q as in quarters. It's a business term for time of the year. So basically a recession is a decline in spending. It means the country is making less money for 6 months in a row. And this has a negative effect on the stock market, obviously, because the companies are making less money because people are spending less. So it's a bit of a vicious cycle, and in the stock market this term is called a bear market. So you get a bear market, which is negative, and a bull market, which is positive. And a bear market is where prices in the stock market drop significantly, usually by 20% in a short space of time. So we're currently just coming out of the coronavirus lockdown, and we've had a bear market this year. I'll put in a graph here so you can see what was happening with the stock market this year. We had, I think the low was in March, end of March. And I just had a look, and we are actually officially in a recession now in the UK, which is not great news, but this can be easily explained. And it's simply because in the beginning of lockdown, all of the businesses, or most of the businesses, had to close, and they couldn't actually sell their goods or services because everyone had to be at home. So it was only really online services that could still function. And what this means is that people weren't buying from the stores. Yes, they were buying online, so some companies were able to still make sales online, but they weren't seeing the usual spending that they were in normal circumstances. And this had an effect on the shares in these companies, so the stock market then took a negative turn as well. And if you think about it, the company is making less money because less people are coming in to buy their products or services, and they're still having to maintain their costs. So they're still having to employ their staff, unless they make all of them redundant. You're still having to employ at least some of your staff. You're still paying rent on the buildings that your business is in. You're still having to pay for products being manufactured or delivery costs, and a good example is pubs. They had to throw away a lot of their beer and all of their drinks because their food had expired. So a lot of companies lost a lot of their products due to expiry. So this means that the company is actually at a loss, and the stocks then decrease in value because the company isn't making as much money as it was before. Now, a bear market is normal. They do occur fairly regularly, and you shouldn't be alarmed if you've just invested your money and then a bear market occurs. The key thing to remember is you only lose your money if you decide to sell at a loss, so when your money or your stock is worth less than when you purchased it for. Yes, there is a case when, especially in coronavirus, some businesses may have gone bust and had to close, and therefore if you had invested into that business you would have lost your money, but the majority of businesses were still able to function. High street stores and online stores, things like Amazon and all of those big ones, if you'd invested into companies that you felt fairly confident with, they should be able to get through this bear market and this recession and the coronavirus, and they will be able to come out the other side, and you'll maintain your stocks. And since the war, there has been a bear market on average every 5.7 years, so it is fairly common. And if you're investing long term, you're likely to see quite a few bear markets occur. You just have to sit tight and remember, if you're thinking long term, the market will recover and your money will make its money back up and then continue to grow. Okay, that's the basics for investing and the stock market. I hope I haven't lost you. Please comment if you're still with me. I know I talk quite fast, and I hope I haven't confused you and used too many big words. But last thing I want to go into, I think, is the most exciting thing, and where I hope to see some of you go if you're looking at investing into the future shortly. So there is such a thing as an index or a mutual fund, and what this means is it's basically one price for one share, and in that share you get a whole handful of different companies for the price of one. And basically you get a really, really small percentage of a load of different companies, which spreads out your portfolio. You can have them in oil, you can have them in healthcare, you can have them in tech companies, you can have them in high street retailers, you can have them in online businesses, you can have them in all different sorts. Oh, you can have startup business ones, you can have the largest companies, all different types of funds that you can purchase, and it makes it so much easier because it takes away the worry of putting all your money into one company and hoping that company grows. Instead, you are putting your money into a whole host of different companies for the same price. And this takes away the risk element a little bit, because if one of those companies goes bust, you won't really see it affect your portfolio and that one share. A lot of the percentages split up between them all is 0.2% of each company. I think it's very, very small. For the bigger companies like Amazon, I think sometimes they're at 5% of a share, but that's around the most that you'll usually see for an index fund. You won't see companies that are like 50% of a share. An analogy I like to use is, instead of buying one chocolate bar, so instead of buying one Snickers and putting all your money into that, you actually buy a selection box, and you're finding a small amount of lots of different types of flavours, so lots of different companies, smaller amounts, but you're still having the same weight of chocolate. Maybe that says a lot about me and my love for chocolate. Now, there is a drawback to the index or mutual funds in that they do cost a little bit more because you're buying lots and lots of different fractions of different companies. But stockbrokers do also split these up further, so you can own a small part of that fund. So they split up the ownership between a certain amount of people to make the price more affordable. So I'll give you an example of a couple of index funds that are the most popular. So the first one is the S&P 500, and this is actually one of the, I don't know if it's the largest or just some of the largest, but it's very large successful companies in the US, 500 companies, and you own a little bit of all of them. And the average growth of the S&P 500 is 9.8% every year. Obviously this is an average. Some years it might be at a negative, some years it might be plus 30%, but over time the average has been 9.8%, which is really, really good to see. A second fund I want to mention is the FTSE 100, and this is the top 100 companies in the UK. This is a very similar thing, but in the UK only. The average growth since creation of this fund is 8.9%, which is also very, very good. Now, like I said, they can be a little bit more costly. The cost of the S&P 500 is around £3,900, and the FTSE 100 is nearly £6,000. It's £5,900 for one whole share. But like I said, there are stockbrokers who split up the ownership between these so that you can own a part of them, and that can be much, much more affordable. The ones I buy are £500, but I think there are some that are around £230, which is much more affordable when it comes to investing your money. And like I say, because it's an average of all of these companies put together, if you invest in something like those two that I just mentioned, you're getting an average of growth across all of those boards. So you would hope that most of them are going to make a positive revenue every year, and so it is much more safer. Okay, I really hope I haven't lost anyone. I'm sorry, I know I talk really fast. There's always the slow down button below. But yeah, that's my beginner's guide to investing. I hope I managed to explain it fairly well for you. Please do leave your comments below. Any feedback is appreciated. So yeah, let me know if you look into investing any more, or if I've completely scared you off.